Well, I think the first thing to do when we look at the mortgage market is really to zoom out and go back to the pandemic. Back in 2020, the Bank of England, as the UK was about to enter lockdown, dropped the bank rate, sometimes called the base rate, to 0.1%, so a really low level. So with that going down to such a low level, people were able to borrow from banks at a really cheap cost throughout the pandemic. So we saw people getting mortgages for 1%, sometimes even less. So since then, the bank has actually raised this interest rate, this bank rate, 12 consecutive times, and this has meant that borrowing is a lot more expensive. There's lots of different types of mortgages, and depending on what type you have, depends on how much it affects you. So with this 12 times, there's some mortgages called trackers, and these literally track that bank rate. So every time that interest rate has gone up, they've gone up too. There's another type called variable rates, which tend to sort of generally follow that rate as well. But the cheapest type of mortgages are called fixed rate mortgages. And what these are is you get the mortgage and you get a price at the time, and it's locked in for a fixed period of time. So a lot of people who in 2021 got these really cheap mortgages, perhaps for 2 years, are now starting to come off them, and they're being offered much more expensive deals. These fixed rate mortgages, they don't necessarily exactly follow the bank rate. They tend to work on sort of long-term predictions of what will happen to that Bank of England interest rate. And at the moment, because inflation's remained quite high, in previous weeks, in the past few weeks, what we've really seen is lenders start to up these mortgage rates in anticipation of us seeing really high base rate from the Bank of England. And this has been passed on, so people who are renewing now are getting really quite expensive mortgages, sometimes close to 6% or maybe even over. So when we talk about mortgage stress, what we're talking about is the affordability really. And yeah, we've got this line that mortgage stress, the affordability of mortgages, is about to reach the level that we saw in the 1980s. And I think a lot of people associate the 80s, obviously I wasn't born then so I don't know, but I think people borrowing them generally say that it's, you know, the sort of worst decade in the 20th century for mortgages. And we saw rates then, interest rates and mortgage rates of often in double digits. And what some people have been saying recently is, look, you know, mortgage rates are only at below 6%. This is nothing like what we saw in the 80s. But actually what experts are saying is that a 6% rate now is equivalent really in terms of the sort of stress and the affordability to a level of maybe 13% in the 1980s. And the reason for this is that we tend to borrow a lot more for our mortgages now. So back in the 80s, people maybe borrowed for a mortgage that would be 2 times their salary because houses cost a lot less. And houses have gone up, as we all know, house prices have gone up well beyond inflation in the past 30, 40 years. So now people borrow a lot more. So even if your rate goes up to only 6%, it's still just as difficult from an affordability perspective as it was in the 80s, it being far, far higher. So that's why people are saying that the rates now that we're seeing are sort of equivalent in a way to the rates we saw in the 80s. Most seem to think that there will be some reduction in property prices in the coming year, and we're already starting to maybe see that. What we're not going to see a return to in the coming years is this sort of double-digit growth that we've maybe got used to. So house prices will maybe a very safe investment. You could assume that if you bought a property, it would go up in price, and we're not seeing that. And the reason for that really, I guess, is partly if mortgages are more expensive and housing costs are more expensive, then people can't afford to take out large mortgages and borrow large amounts of money to buy expensive houses. So you start to see people on the fringes, people like renters or those looking to upsize. They might think, can I really afford to make that next move to a more expensive property? And as a result, people won't pay those higher prices. It'll take a little bit of time for that to sort of filter through. It's not going to happen immediately with these high rates, but I think some experts are thinking that sort of later this year, we might see that sort of filter into the market, and that's when you might see these significant house price falls. With the Bank of England forecast to rise interest rates more in the coming months, we're going to see, sadly, more mortgage misery for many. That means costs each month going up probably, perhaps into next year as well. What that means for house prices, though, it remains to be seen. Unless you've got a crystal ball, you're not going to know. But we will hopefully see a little bit more and have a better idea later this year.